Good morning to you both. David, the jobs number, certainly better than the consensus forecast, a little bit stronger than you were expecting on both the payroll growth and the wage growth line. I wonder, it comes, after a few days when it seems people are getting more comfortable with, the Fed getting closer to its destination on rates and maybe higher probability of a soft economic landing. Does today's data alter that picture at all for you?
Not really. I think this report's not as strong as it looks on the headlines. I noticed, first of all, there was an increase or decline in the number of temporary workers, which is always a bad sign. But also the household survey lost jobs the second month in a row. And the payroll survey has got this births, deaths model for companies, which often means that when you are at a turning point in the economy, it tends to overestimate the number of firms that are actually in existence and therefore overestimate payroll job gains. And I'm very suspicious about these gains in construction and manufacturing because everything else I'm seeing suggests that those sectors are probably shedding jobs at this stage. So I think beneath the surface, there is more weakness here. And even on the wage gains, I mean, we had a shortening of the work week. It was because of bad weather. It's also because of illness. I mean, there are almost 4 million people who weren't working during the survey week because of their own illness, which is way above what it should normally be in November. So I think these things are distorting the numbers. But overall, when I look at the overall mosaic of what's going on in the jobs market, I think it's still a moderating year. And I think the Federal Reserve will ultimately have plenty of excuse to taper down the rate hikes and then pause them in the first quarter of next year.
All right, so a pause not too far in the future in that scenario. Mona, what does it mean from an investment perspective at this point? We had the S&P 500 rally back to above 4,000. It's kind of in this zone where it's make or break for whether this is just another bear market rally or not. And then, what does next year hold if, in fact, the consensus is right that overall earnings numbers probably have to come down a bit?
Yeah, it's a great point. And, on the labor market broadly, we also think that the labor market tends to be a lagging indicator. So if we have coincident leading indicators like LEIs, like the yield curve, even like housing market and the broader picture we're seeing real time in terms of tech layoffs, those tend to be the more leading indicators of the economy. And you will start to see softness in the labor market, we think, in the 6 to 12 months ahead. Now, keep in mind, we're starting from a position of relative strength, and that's what kind of gives us comfort in that we won't see this deeper, prolonged recessionary environment. But to your point, we do think that the first half of 2023 brings some softness, not only from the economic picture, the earnings picture, earnings being revised downward, but we could start to see market volatility return. And in fact, we think markets go through this period of what we are calling a bottoming process before then kind of looking forward towards that recovery. And so we think the first half or so will still be led by those defensive value parts of the market. But then we start to see moderation, a peak in Fed funds rate, perhaps a peak in yields, perhaps potentially a move lower. That gives us better balance for the rest of the year where we think some parts of quality growth start to rebound. And in fact, we see better performance overall from both equity and the bond space.